Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth together.
Hey, how's it going, everyone? It's James Santiago, and you're watching your show, Learn Wealthy. This Monday market update is gonna be juicy. We got the new non-farm payroll report from the BLS. The Un-Inversion of the 2-year and 10-year Treasury spread has been sustaining. Rate cuts and many more. Let's break it down. Alright, let's get the basics out of the way. The US economy added 187,000 jobs in August. 187,000. That's right, folks. That's a whole tiny bump. But hey, that's far better than nothing, right? For context, this is the third month in a row of slower job growth. Apparently, the job market's new motto is slow and steady wins the race. But only this race. We're moving like molasses in January here. Now, here's the real kicker. The unemployment rate jumped to 3.8%. Oh no, call the press. We went from 3.5% to 3.8%. A whole 0.3%. Some might say that's still historically low, but let's not get too excited. Why did it rise? Well, more people are looking for work again. Maybe folks finally realized that their side hustles were not going to pay the rent or buy groceries in this Bidenomics. So, back to the job hunt they go. But it's not all bad news. We have some good news. Wages are still growing. The average hourly earnings are up to 0.2% for the month. A whopping 11 cents per hour more, people. That's enough to, I don't know, almost afford like one extra egg per month. Inflation may still be hanging out with us like that one guest who doesn't know when the party's over. But hey, at least we can all feel rich for 11 more cents an hour. Now, where are all these jobs coming from? Well, healthcare and social assistance added 97,000 jobs. Because let's face it, we all need some assistance dealing with this current state of economy. The hospitality sector added another 40,000 jobs because people still want to get out of the house and forget their problems for a night or two. And meanwhile, the tech sector is still handing out layoffs like free samples at Costco. But don't worry, maybe they'll pivot to the booming healthcare industry. I hear it's hiring. Oh, and here's the part that BLS loves to do. The revision section. Remember last month's report where we thought job growth was a bit stronger? Yeah, well, turns out they were just kidding. July's number was revised down by 30,000 jobs, and June knocked down by another 80,000. It's like the BLS is telling us, hey, those jobs you thought existed, yeah, not so much. I'm starting to think these reports are like your friend's estimate of what time they'll arrive. Always off by a solid 30 minutes to an hour. Now, what does this all mean for the big boys at the Fed? The economic PhDs? You know, they've got their eyes glued to this jobs report, deciding whether or not they're going to keep with a pause or they'll start cutting interest rates. Hit the like button if this report made your day a bit brighter, and don't forget to subscribe to Learn Wealthy. Now, let's talk about the 2-year and 10-year Treasury yields. That's right, the yield curve has decided to stop doing its backflip and return to what they call normal. But don't worry, it's still a sign that something, somewhere, is on fire. Let's break down what this means for rate cuts, recessions, and whether or not you should start panic buying canned goods and toilet paper. Alright, for those of you who haven't been nerding out on bond yields, here's a quick rundown. The 2-year and 10-year Treasury yields flipped or inverted a while back. Basically, short-term bonds were paying out more than the long-term ones, which in finance is like saying, I'll pay you more to lend me money for 2 years than I will for 10. Sounds weird, right? Well, that's because it is. When the yield curve inverts, it's usually seen as a big, flashing neon sign that says, recession ahead. Kinda like that check engine light that you pretend isn't there. Inversion has been a pretty reliable recession predictor. But now guess what? The curve has uninverted the 10 and 2-year treasury. So everything's fine now, right? Now that the 2-year yield is lower than the 10-year again, economists are acting like the universe has corrected itself. Economists in the mainstream media. But before we throw a party, let's talk about what's really happening. The Un-Inversion doesn't necessarily mean we've dodged the recession bullet. It just means the market thinks the Fed's rate hike party is winding down, and everyone's waiting for a rate cut like it's a Black Friday sale. So now that the yield curve has uninverted, people are expecting rate cuts. Why? Because when the bond market starts pricing in lower yields, it's usually a bad sign, and the Fed will eventually throw us a bone and cut rates. Rate cuts could be on the horizon, but knowing the Fed, they'll probably wait until we're all begging for mercy. As Fed is always just reacts with the economy and is never in control. Now here's the fun part. Un-Inversion doesn't mean we're out of the recession woods. In fact, historically, Un-Inversions happen right before recessions hit. Yep, that's right. The market lulls us into a false sense of security like, hey, everything's normal again. Nothing to see here. Then, wham! Recession! It's almost like the economy is playing a game of hide and seek, and we're the ones wandering around with a blindfold on and bumping onto walls. Oh, an Un-Inversion. That must mean the coast is clear, right? Nope. And then the economy might just be hiding around the corner, ready to jump out and boom! Recession! Into our faces. All right, we're back at the CNBC website. Not because I like them, but take a look at last week. All these indexes, S&P, Nasdaq, Dow, FTSE, all of them just crashing all week last week. And as you can see, the 2-year and 10-year, the 10-year is finally yielding more than the 2-year. That means it finally un-inverted, and we are going towards our base case of recession. And we're back at the goldandsilver.com with a spot price of gold just hovering around 2,500 per ounce, and the silver hovering at $28 per ounce. And gold and silver ratio is still over 80. Gold being just hovering around 2,500, not being faced by all these stock indexes crashing, and the yield curve uninverting, is doing exactly what it should do. And we're back at the Federal Reserve's website, the Fed. And as you can see that, let's zoom in on that Un-Inversion, I mean. As you can see, it looks like that Un-Inversion is going to start to sustain. It's uninverted now by 0.06. And if you've been watching Learn Wealthy, you know that JP Morgan CEO Jamie Dimon sells about 33 million shares, completes plan. Basically, this guy sold a bunch, millions worth of his shares in JP Morgan. And the Walton family of Walmart sold nearly 9 million shares of Walmart stock last week for over $1.5 billion. The sale brings the family's total proceeds to nearly $2.3 billion in the span of only 3 months. And this report was in February 2024, this year. Warren Buffett just sold another $3.1 billion worth of Berkshire Hathaway's largest holdings. Here's why. Warren Buffett, he's been selling his majority of his Apple shares, Bank of America shares, and then Jeff Bezos. So basically, all these billionaires are selling their shares in the stock market. I wonder why. Does it have to do with what we always talk about in this channel, the yield curve uninversion? And again, if you look at the Buffett indicator, in long-term trends. If you look at the Buffett indicator, the stock market is pretty much nearly at its all-time high. The Dow to GDP, if you look at the S&P to GDP, it's pretty much in its all-time high. It's just like a sneeze away from its all-time high. And there is no support for the stock market to continue to go higher. And it's not fundamentally sound. The stock market should be only about at least maybe 50 or to 70% of the US GDP. All this doesn't make sense. The math don't work here. In spite of all this happening, I still do buy dividend stocks, but I toned it down by a lot. I'm just buying like bits and pieces now. Mostly for dividend aristocrats, dividend stocks that have been there for centuries, like Hormel and all of these dinosaurs. But I've toned it down by a lot, even with those kind of stock. But I was never into growth stocks anyway. But I am trying to hustle up and gather dry powder for whatever's coming, whatever these yield curve and these billionaires selling off their shares and this inflation going crazy and the inverted yield curve and all these things together, and that's why we study these things, so we can position ourselves in our portfolio. And I'm leaning into a hard landing, if you know, and that's not doom and gloom. That's preparing for opportunity. I'm not like a daily trader either. I read long-term cycles like the yield curve and Psalms rule and adjust my portfolio accordingly to that. If you like this episode, please hit the like button and subscribe. And I need to know what you think in the comment section. Stay tuned for future episodes like the FOMC Fed meeting that's coming in around September 17 this month. And I think that's when we're going to know if the Fed is cutting rates. If the BLS is going to revise their job numbers again this month, you will be updated in this channel. And I hope you like this episode. For more finance, real estate, investing, and macroeconomics, watch Learn Wealthy. I'll see you on the next episode.